Well, good morning. My name is Steve Sadler. I am the CEO of Allegiancy. We're a commercial real estate asset management firm that is engaged in the Regulation A+ process right now as we speak. You'll see us pop up in the presentation here in a minute. And what I want to start with is just a conversation about the landscape in commercial real estate and crowdfunding, Regulation A, et cetera. So the remote control somehow got lost in transition. So I've got my friend Howard is going to push the button for me. Take it away, Howard. So the Jobs Act passed in 2012 is clearly a catalyst for some major changes. It took a while for the rules to come out, but for the first time in living memory, investors are able to get closer to opportunities rather than farther away. It's been a very long time since there was securities reform, and we think this is a very big deal. It's really rocket fuel for the entrepreneurial class. It's rocket fuel for the American economy. And just like a Saturn rocket, you've got three stages. First is 506C, which is called, what is that in Reg A language? I think it's Title II. This 506C allows you to solicit public solicitation of accredited investors on private placements. Brand new idea, had never been done before. Everyone thought it was going to be calamitous, but it really hasn't been. But for a sponsor, this is the first time you've had the opportunity to create a brand for yourself that the public can see and hopefully would be recognizable and ultimately have value for you in the long term. So 506C was the first important part. That really is the exemption, the securities exemption that a lot of your larger platforms, Realty Shares, Early Shares, et cetera, that's what they're relying on is the 506C exemption. The next big piece was Reg A+, and those rules became effective something like August of 2015. And then Title III is happening now. Title III is what I call the real crowdfunding, which allows anybody to essentially raise money from anybody. And the rocket's taking off, it's building up momentum, and good things are happening. We're seeing a lot of activity in the marketplace and a lot of change. And in our view, what you're about to see happen to Wall Street, to the investment banking and private equity markets is a lot like what has happened to the taxi business. Uber came along, nobody was paying attention. All of a sudden, it's better, it's easier. The economics of the Uber system are far superior to a traditional taxi company, and Uber has taken off. You can see ridership skyrocketing. You have a little bit of latency in the early months, and then all of a sudden, in all of these cities, Uber is everywhere. You see the same thing with Airbnb. Again, you have a company that's leveraging technology to take over, essentially, a very large, very established industry. Airbnb is the third largest hotel company in the world now. With more room nights than almost everybody else. And you can see that power curve of growth. We think you're going to see the same thing in the securities world under the Jobs Act. You're going to see some amazing changes. 506C is a big part of that. The private placement marketplace for Reg D private placements is more than 100 times the size of what Regulation A offerings have been in the past. So that is the sort of the belly of the beast in terms of actual securities offerings. And for an investor to have the opportunity to be exposed to offerings via the internet, on a platform, direct communication with the sponsor, is a new and powerful thing. And we're talking about disintermediation. The brokers and the registered reps are no longer required, and you think if you're one of those people, you need to be careful because you cannot rely on filtering information for your livelihood anymore. Your clients will have access to direct investment opportunities, and so if you're not in the game is going to roll right over you. This is a great example. It happens to be an affiliate of ours, Real Estate Value Advisors, did a commercial real estate investment syndication using the 506C exemption. This offering was placed on Early Shares platform, was available to the public. Obviously, there's a process of validating that you're an accredited investor before you can see all of the offering documents, et cetera. But we did this offering on a Class A office building based in Raleigh, North Carolina, that's paying about a 7.25% cash flow for, institutional quality stuff. Prior to that time, very unusual for an individual investor to have access to an asset like this. And we had some success on early shares, and that's, for us anyway, it was a test and it's an exciting opportunity. And we're doing it again. We have another office building asset based in Charleston, South Carolina, also paying out about a 7.25% coupon that is going to go up on early shares here shortly. So again, what you're seeing is a lot of, if you go to these various things, Realty Mogul, Realty Shares, early shares, what you're seeing is a lot of small transactions, but more and more institutional quality, seasoned professional sponsors are showing up. And I think that transition is going to accelerate. And so the second piece is the new Reg A, or A+. Here we see this as a major innovation. But the thing that's interesting is the 506C is really where all the real estate activity has been. To my knowledge, to date, there has not been a direct real estate offering under Regulation A+. And there's some reasons for that. There are reasons that you haven't seen those yet. One of the reasons is that the timing of getting things approved through the SEC is particularly painful for a real estate deal. And so what you see under Reg A right now are mostly operating companies. You're seeing growth companies going out to raise capital rather than doing a venture round, or going out to raise capital rather than taking private equity money. They're raising it directly from an interested public and reaching those investors without the limitations of an accredited standard being required. And so a company has an improved ability to source capital, to reach out to interested parties, build an audience, and raise that capital, in theory, more cost effectively than you can through a traditional private equity or an angel or venture capital group. And you have, at least in theory, the ability to maintain more control of your company, not ceding control of the board, et cetera, to a third-party outside investor. And I think one of the things that we have to think about is the size of this opportunity. Not every company is going to be a Google, but if you look at the public equity markets in the blue dot, that's how big that market is in dollar terms as compared to private companies. And so for private companies to be able to raise capital more efficiently using Regulation A+ is a very big deal. And it should be something that can dramatically improve our economic performance, dramatically impact job creation, innovation, technology's acceleration, and as Kareem was saying, defining and building that future. So we think this is a big deal. And Allegiancy is taking advantage of that opportunity. We are a commercial real estate asset manager. We don't own the properties, we make the properties perform. And Allegiancy is a fee-based, pure play, and we're in the market today raising $30 million under a Reg A+ offering. And that's something that, actually we're not in the market today, we'll be in the market on Monday. The SEC has just come back with sort of, all clear signals for us. And so our offering is the kind of thing I think you're going to see more and more of. It's a young company that's profitable today. We're offering $30 million in common shares. We expect within 12 months to declare a 4 to 6% dividend on those common shares. The shares will be liquid and tradable on the over-the-counter, the OTCQX exchange, where names like Heineken and Roche and Bombardier trade today. Our operations are profitable. We're fee-based and counter-cyclical, which is to say that in the downturn, our asset management operation was more profitable and had growing revenues, where a traditional sort of real estate ownership model in the downturn was suffering. So you have an opportunity as an investor to gain exposure to a real estate asset class without all of the volatility of direct equity ownership. And so we like to say that Allegiancy is an offering where you get more alpha with less beta, and that's a good thing for portfolio diversification. And the company's growing very fast. In the last 24 months, we've grown at a 400% clip. And from our perspective as an investment, This is kind of a boring company. It's not sexy. We're not making cute little gadgets and you know, I don't know, fancy watches or something. But what we do is manage a piece of a very large business. Commercial real estate is more than a $15 trillion asset class in the United States, roughly equivalent to the total equity markets and publicly traded equities in the country. The industry throws off $886 billion in revenues each year. So in our case, Allegiancy is implementing technology to make those operations more efficient. And if you can move the needle just a little bit on an $886 billion revenue industry, you can have an awfully big impact. And we are a market-leading pure play. We're the only guys out there that are a public or are headed to be a tradable liquid security that does manage real estate on a fee-for-service basis and doesn't get bogged down in all of the other things. So real estate is a unique industry in that you have the 1950s vertical integration sort of mindset where everybody tries to do everything for everybody. And you'll have a large name like CBRE, and they're doing leasing and property management, investment sales, they're doing financing and capital markets, they're doing everything from soup to nuts. And it's hard to imagine that anybody really believes that's the most efficient, that they can actually be the best at everything. And so at Allegiancy, we've chosen to specialize, focus a lot of our energy on building a technology platform that allows us to compete and to excel. And that has delivered 250 basis points of improved return on equity for our property owners, which is a big deal, again, in a $15 trillion market. And we are currently all across the country in 24 different cities, 11 states, with about $1 billion of assets under management. And so there's the little picture. And so part of what I'm trying to communicate here is that not only is Allegiancy, in our view, a great example of what's coming in Regulation A+, it's a company that with additional capital will grow very rapidly. We have 25 employees now. We're expected to be about 50 employees by the end of the year. And so you see that the capital goes to work in the company. Your opportunity is to invest in these companies earlier and get a bigger piece of the growth and the gain that heretofore has been largely captured by private equity investors that most of us didn't have access to. So from Allegiancy's perspective, we bring a seasoned team, we bring serious technology and stunning growth, and we think it makes for a great investment. And starting next week, we'll be out telling that story in earnest to investors all over the country. And so back to the big picture, Title III is the third part, or the third stage of the rocket that I described earlier. Title III is true crowdfunding that would give essentially any individual the opportunity to go out and raise $1 million of capital from investors with little or no criteria attached. You don't have to be accredited, you don't have to be rich, you don't have to be smart, you're able to invest in whatever that offering is. There are some problems with the way the rules have been written in Title III, and those are being at least talked about as something that might get addressed. But I don't think you're going to see a big impact, at least for the moment, with Title III, particularly in real estate because it's a small dollar amount. I mean, $1 million of equity sounds like a lot of money until you try to actually go out and buy some buildings with it and you find that it's really not that much. So we'll see how Title III works out, but I think for most people in this audience, focusing on 506C and Regulation A+, that's where most of the action and most of the dollars are going to be going forward. And I think that's it.